certainly by September. If they don't reverse by September, the market's going to have significant downside. So I think that's what's going on, is the markets already are anticipating their reversal in the next, few months. That's why the yields are dropping. That's why stocks are now rallying.
Down weeks on Nasdaq, we're not turning back up. If we correlate that to, the US 10-year Treasury yield, we see that the US 10-year has done an absolute U-turn. So it went up to about just under 3.25%, now back at 2.72%. What is this? Is this a relief bounce, or is the market saying, okay, the Fed's work has been done?
So I'll kick it off. My view is that we're probably going faster into recession than anybody expects, and probably much deeper. I think that's coming. I think we've got a replay of 1974 underway, which was the ISM the Institute of Supply Managers Survey, which is a good guide to the business cycle, went from 56 to 30 in 4 months. Similar setup with oil prices screaming higher, supply restrictions, rates going up, the Fed hiking, all of the same stuff. And there's several of these in history. Equities don't like it generally. The bond market tends to turn earlier, which I've been waiting for, and bonds have started rallying to say, you know what, things have gone too far. I still think we probably have another leg lower in equities into the final low, much like we had in 2018 as well. So I'm not short equities. I've been buying bonds, and I've been buying kind of growth equities, all the stuff that's super beaten up, because I think that the cycle plays out faster than people imagine, and the outcome is a U-turn by the Fed.
Jurrien, what do you think?
Well, there are two kinds of bear markets, right? There are ones that are associated with recessions. They produce earnings contractions, and they are a double whammy of valuation going down and earnings going down at the same time. And so just mathematically, if the PE goes down and the E in the PE goes down, then the price has to go down a lot to keep up with both of them. And those and so many of the bear markets we've seen, and I've tracked them going back 150 years, are of course associated with recessions. But a number of them are also non-recession bear markets. And until proven otherwise, I'm staying in sort of the glass half full camp for now. And those bear markets that do not produce a recession do not have an earnings decline, and therefore all of the correction happens in the PE. And so far, that's what's happened here, right? The market peaked January 4th, although the meme stocks, the non-profitable growth stocks, they all peaked almost a year and a half ago and are down, 60+%. But the S&P 500 peaked in January 4th. It was down 20.9% at the intraday low a week ago, Friday. The PE went down 25 to 30%, depending on whether you use the trailing or the forward PE. And the duration so far has been 4.5 months. And when you compare that to non-recession bear markets in the past, so 94, 98, 2011, which was down 21%, 2018, which was down 20%, and a few others, they last 4 months, they go down 22%. The PE goes down about 28%. And we followed that script perfectly. And so far, the earnings estimates are holding up. The revisions are down. About half of the companies in the S&P 500 are seeing upward revisions. The other half are seeing downward. So it's clearly the bloom is off the rose, and clearly consumers are seeing their disposable income being eroded by inflation. The ISMs are down, as Raoul mentioned. So clearly the economy is slowing, and there's now a negative wealth effect. But when you think about what the Fed is trying to accomplish, that's exactly what the Fed is trying to accomplish. So again, maybe I'm being too optimistic, but until the earnings numbers start to fall apart, this has been a complete valuation reset from 23 times earnings to about 16. And so that doesn't make the market cheap, but it does make the market fairly valued based on what at least I know at this point.
I mean, you say that the earnings haven't been disappointing yet, but there have been a lot of very disappointing earnings. I mean, Netflix was severely disappointing. Snapchat was severely disappointing. We have had some really bad misses. On top of that, we do know that there's production issues that are happening, supply chain issues, which are going to impact a whole lot of companies. And I think that no one knows the extent of those production issues. We know that. And then we've had 1 quarter of negative GDP growth. We're probably going to get a 2nd quarter of negative GDP growth if our estimates are correct. That would officially put us into recession. Are you still confident that it's just the P that's going to drop and not the E that's going to drop?
Well, first of all, the NBER is the arbiter of recession. So 2 quarters of negative GDP does not necessarily mean a recession, but that's I'm splitting hairs at this point. But yes, there's been some big earnings misses, especially on the retail side. It shows you that consumers are seeing their disposable income being eroded by inflation. And if you think about it, consumer savings as a percent of disposable income, it was 7% pre-pandemic. It shot up to 35% when the CARES Act kicked in and people had basically no place to spend their money. It's down to 4%. So it's definitely, the economy is definitely slowing, and there's a negative wealth effect. Consumers are spending their money differently than before, less on durable goods, maybe more on travel. You look at TSA checkpoints here in the U.S., they're at the highest. There's been no erosion in people's travel. So people are still spending, but clearly inflation is taking a toll. And again, on the earnings side, earnings growth last year was 40%. That was the peak. As of right now, the year-over-year earnings growth is still 18%. The estimates are for 10% for 2022. Maybe there's some downside risk there, but the numbers have actually held up pretty well. And to see revisions, kind of upward revisions and downward revisions, go from very lopsided to more balanced to more downsided is something you would expect in this part of the cycle. But again, there's a big difference between a hard landing and a soft landing. And generally, historically, the Fed, when it has had to fight inflation, it has led to a hard landing. And Raoul and Dan know this history as well as I do. And so maybe history is not on our side, but until I actually see it come out of the earnings numbers, I'm going to assume that this is a valuation reset. And based on the inverse of the 2-year Treasury yield, which is a very good metric of forward guidance from the Fed, the valuation reset basically has been complete. But having said that, if we now start to rip higher, as we're starting to do in the S&P and the NASDAQ yesterday and today, pretty soon we'll get to a point where the market's back over its skis and it's trading at a 20 multiple when it belongs at a 16 or 17 multiple. So I don't think there's a lot of upside at this point, but like 1994 and 2018 and other kind of prolonged Fed cycles, I think the markets are in a holding pattern, and probably the lows, I don't want to be too predictive, but my sense is that the lows are either in or mostly in.
Wow. Dan, what do you think?
Look, I've been sort of vocal about this on Twitter. The Fed over jawboned is how I'm describing it. The Q1 Fed funds, I think, are still at 3%. There's no chance at all, zero, that the Fed will be raising 2 percentage points between today and Q1. And so basically what happened simply was that the Fed funds market went to a place, at least in my view, that it was unreasonable, caused sort of, let's call it a mini panic, or maybe it's a massive panic. I don't know how you can describe it, in the stock market, in all assets, anything driven by liquidity. So, and I think that's being corrected now. 3%, was sort of the breaking point. Inflation has already peaked and will be coming down for the rest of the year. The problem is that the Fed may have, jawboned us to a place where the data really collapses beyond what certainly we expect and they expect, and using the blunt instrument again to, crush the economy, to, guarantee in a way that their inflation readings are, I don't know, acceptable to them, I just think is a bad strategy. So, I mean, if I were at the Fed, I would already be easing up. They're not going to. My sense is they're going to wait for 3 months of very clear data, as they call it, or whatever it is, 2 to 3 months of very clear data. But all the forward-looking data is already very bad. I mean, all they have to do is look at, Jurrien or Raoul's data. And I think we still have the same problem, is that we have academics sitting on the Federal Reserve Board, not market players or some. I'm not saying we should all be that way, but we've seen this happen many times before. Why they don't look at the forward data, I have no idea. So, I've got an
amazing chart to show you about the forward data. Let me see if I can share it.
Can you quote it up and just share your screen? While you're doing that, I must ask you guys, you've all said the same thing. The Fed has already done jawbone the market. What has the Fed actually done? I mean, they've raised by 0.5 basis points. They've been hawkish in their words, in their narrative. They have just started the quantitative tightening, or are just starting the quantitative tightening. What have they actually done, though?
They've done a lot. I mean, look at the 30-year mortgage rate. I mean, housing will collapse, period. I mean, they've already lost $30 trillion of value. Go ahead, bro.
This chart is rate of change of mortgage rates, 2-year rates, oil, gasoline, and the dollar.
Yeah, this is a good one.
Over the business cycle. It's suggesting we've just had the largest monetary tightening in history. Yeah. And that what they've done, the markets have done, because the Fed were barely involved. Yes, you're right, they're jawbone. But what they've done is cemented in the KK precipitous drop. As I said, that the last time we saw something like this was 1974, and it was over pretty quick. Now, it depends whether it's a quick thing or a longer thing. I think it's a quick thing. So I think
they're going to reverse, Raoul, as you said. They'll reverse, I think. And
when you go back in the ISM, as soon as the ISM approaches 50, they stop, because obviously below that you start seeing unemployment rising, other bits and pieces. So, my guess is we get an ISM print of around 52 below consensus, and then by July it's below 50, and so they're done. That's my view. I think it's done.
And if the Fed goes to with TIPS break-evens falling rapidly, I mean, the 5-year TIPS break-evens down 75 basis points or so in the last month, that creates a lot less pain in terms of nominal yields having to shoot up higher than inflation expectations to get to something resembling a restrictive policy, right? If a neutral policy is 2.5, which is what the dots suggest, and what R star plus 2% inflation would suggest, then going to 3% actually is not that restrictive. But but to your point, Raoul, the markets through its jawboning has done. It's let the markets do a lot of their work. If you look at the cost of capital, mortgage rates, corporate yields, even the discount rate in the discounted cash flow model, it's been a formidable reset. And I think the big question is, how far does the Fed have to go above neutral, and how long does it have to stay there? I think the risk is not so much that it has to go to 5% instead of 3%, which obviously would be a huge difference because the inflation expectations are already starting to moderate. But the risk is that, the CPI goes from 8.5, it's now at 8.2, it goes to 5 or 4, but it doesn't go any lower. And then the Fed just cannot, it will have to stay restrictive for a long time. And it's not necessarily the end of the world for the markets, but that implies a much lower PE than what otherwise would be the case.
Zero chance. I just think the markets have zero chance of that. Of going above this neutral. There are a lot of other factors at play. The markets have already, over tightened. The whole thing is going to come undone. And it's unfortunate that they don't, respond in front of data, or let's say in the face of obvious forward data. That chart that Raoul put up is really all you need to know. Anybody listening to this, 30 years of macro experience, and Raoul, you've got 100 years here on the only thing you need to know is that chart. Okay, that's where we're going. Very high degree of probability. My view is that they will shift.